Howdy, how you doing? Hope everyone has been doing great. Thank you to everyone who's tuning back in for my 10K to 100K challenge. This is just week 2 of price action. To be honest, we don't have much to go over. Typically, I like for my positions, I like to give them more time, and 1 week just isn't enough time for Theta Vega to do its thing on my options contracts. But we do have a few updates and we can learn a lot from them. In today's video, we are going to cover intrinsic and extrinsic value, and we're going to cover call options. I do have future videos planned later on that go in detail on each topic. I know this is a lot to digest, no worries, but in order to learn, one must ask questions. I don't know everything, nor do I claim to know everything either. So if you do have a question, or if there's something that may not be clear to you, just drop a comment. I'd be more than happy to clarify for you guys. I know this is a lot to learn, trust me. It's taken me 5 years to somewhat grasp these concepts like second nature. So I know it may be complicated, but we're in the business here of trying to make some money. So without further ado, we have about 10 minutes left into the market. We're going to analyze what's been happening because it's been an insanely crazy week. There's been a lot of volatility, namely because of the Fed raising their rates most likely pretty soon. This is spooking investors because higher rates means money is harder to borrow. It's more expensive to borrow money, which eats in to the profits of growth companies. Because remember, we talked about growth companies in my Stocks Explained video. And in that video, we covered growth stocks. So those kind of companies, think Tesla, Roku, those kind of big growth companies, we value those companies now largely based off of the anticipated profits of the future. So if it's harder to borrow money now, that's going to eat in to the profits later on into the future because rates are higher. In other words, it's harder to borrow money and more expensive at that. ETFs lately have now been on a downtrend. As a matter of fact, SPY has broken out of the trend, out of that bullish trend that has been... Siri, shut up. I don't need you right now. SPY broke out of that trend that's been holding for, over a year, almost 2. So right now, tech stocks are just getting battered, and trust me, it's been extremely volatile. So let's now swap over to Robinhood before the market closes and execute one trade that I was thinking about earlier today, and then give updates on my other positions. So let's do this. Okay, so here we have Think or Swim. This is TD Ameritrade's trading platform where you can do TA, otherwise known as technical analysis. Again, we're going to cover some terms such as RSI, MACD, and implied volatility, as well as candlesticks. If you guys want a series on how I do my technical analysis, or at least what I do and what indicators I use, and in essence, how I have my setup, just drop a comment. I would love to teach you guys technical analysis for those that are interested. It's a phenomenal way to at least, collect clues or have hints about what a stock is going to do in the future based off of past results. Now, the thing about technical analysis, there's a lot of TA heads who all they do is TA and follow it like a religion and then get mad when they're wrong. And that's the thing about technical analysis. It's not always right. We can at least pick up some hints and clues, though, from the graph to potentially maybe make a profit. There are certain shapes on the graph that are just repetitive. It's just statistically likely that, the stock market is based off of fear and emotions, based off of greed and fear. So there's certain chart patterns that present themselves historically time and time again and typically mean something. For example, like a double bottom or a bull flag. Those are things that I might say. I understand not everyone understands these concepts. However, it is important to use a wide variety of tools to be able to invest. Investing isn't one thing that you learn from one day to the next. So here we're on a journey to learn. So again, if you do have questions, make sure to drop them down below and let me know if you guys want a TA series. But anyway, this is a 1-year chart on Roku, and as you can see, it has been on an enormous downtrend, as you can see by these two channels. Channels are just funky words. Think about like a highway, in other words. It's a piece of road where the stock is in between. It's fluctuating between those two borders, if you will. So as you can see, Roku has had a high, and by the way, this was a huge double top. A double top is when you have, it hits a certain price point, it goes down, then it hits it again. It hits it one more time. That is a bearish indication. That tells you that most most likely this stock is ready for a roller coaster down. So if we zoom in here, we went from 490 and currently Roku has been shorted and battered continuously and currently is trading at about $170. That in itself presents itself with a great buying opportunity. Obviously, it's been taking a beating. It could continue to go lower. However, I think this is pretty much done in terms of bearish momentum. I think eventually this is going to start climbing back up. At least that's the goal. Plus these indicators down here, for those of you TA heads that know all of this, implied volatility almost at its highest point that has been in the last year. The RSI is also going on an oversold signal. It's pretty clear. It had an oversell signal not too long ago. This was around November, but obviously the TA was incorrect. That stock was not done. The trend was still presented and it kept going down. So these indicators aren't always right. And then the MACD, as you can see, this stands for the moving average convergence divergence. So if you look, the blue line, it's starting to curve back upwards, and it looks like if it continues this trend at any moment in the next day or the next business day or so, maybe the next 3 or 4, this blue line is most likely going to start overtaking that yellow line, which is a bullish indication. But again, it's not always right. My point being, I believe I have a bullish sentiment on the stock. And because we're smart about our money, we are going to be smart about the call option that we're going to choose. Again, I know a call option may be foreign to some of you guys right now, but we will cover call options and put options in very great detail in future videos. But for today, just know we are going to buy a call on Roku. Not just any call though. An FD is typically a stock that is expiring in the next day or so and is far out the money. And this is what Wall Street bets essentially gambles on. We're not doing that. We're better investors than that. So if we let me go check my buying power really fast. And I have margin enabled, even though I'm trying not to use margin. You can't use margin when buying options on Robinhood anyway. So we'll be restricted to about $750 or so. Now, I already researched this beforehand, but we're going to go over to the September expiration, which gives us about 9 months for the stock to move in our desired direction. And since we only have, it would be nice to buy a Leaps. A Leaps would be a call option that's deep in the money, but as you can see, that one costs about $4,000. That's because that's $44.65 in premium for this $150 strike call. Times 100, because a call option controls 100 shares of the underlying stock. We'll go over all of that in the call explained video. For now, just know that more or less we'll only be able to afford probably this one. This is the $310 strike call. It's going to cost us $628. And if we look at our Greeks here, our Greeks are so important. I look at these constantly throughout the day: delta, gamma, theta, vega, and rho. For now, for the time being, delta is relatively low, but that's okay. We have plenty of time. Deltas refers to the change in the stock options determined by a $1 increase or decrease in the underlying. So the delta is rather low, and our theta is 0.04. So in other words, the stock option is losing about $4 in premium per day should everything remain constant. That one's looking good. We don't have much time anyway, so we're going to go ahead and buy the long call. So again, we're going to verify this is the $310 call on Roku. For the 9/16 expiration, we're going to hit continue. Because we only have 2 minutes left, we're going to have to do a market order. So we are going to have to pay a little on the upper end just to get a fill. We're going to review our order. That's basically as close as you can get to the ask without it being at the ask. Let me put in my password here really fast. All right, and it looks like we got a fill. So we have a +1 here. Now we have to go to our portfolio and make sure that it did fill. Our buying power has not been reflected. Oh, there it goes. So it did go through. Wonderful. So now if we look here, we have the Roku $310 call. Now that the market is going to close and I executed the trade, let me go in. There's the market bell. Okay, so this is my reasoning for this. Eventually, as you could see from the deltas on this stock option, it's 0.17. The point is to delta farm. In other words, instead of paying for a deep in the money stock option and pay a hefty premium. Because the stock has been battered for so long, I anticipate this stock to rise. In other words, the deltas will grow organically thanks to gamma pushing it higher. So when that delta hopefully eventually gets to a 0.6, 0.7 delta, I can then start selling calls against this one. And not only that, this stock option would have appreciated in capital gains immensely. It would have grown by so much. Hi, Bean. Say hi, mamas. The market has been on a terrible downtrend, and at least my personal opinion is that it's nearing the bottom, at least I hope so, and we're hedging our portfolio, anticipating that bullish tendency upwards here in the medium-term future. I'm not entirely too optimistic that the stock is going to reach $310, but that's the beauty of options contracts. You can sell them to someone else and give them the risk once you're satisfied with your profits. So again, I'm not 100% positive that it's going to hit $310 in 9 months. As a matter of fact, that's pretty unlikely, but all I needed to do is to rise in value so that the stock option also rises in value with it. So at least that's my reasoning. Now, let's look at our other positions. So we have our stocks that we had bought the other day, namely Coca-Cola is about flat. We're about 0.36% on that, which is about a quarter. So nothing too exciting there. But that is a dub. DraftKings has continued to go down. So if you can see on a weekly basis, just from last week, we bought it at $26 and now it's at $20. This is actually a great buying opportunity on DraftKings. Right now would have been a great time to buy some more DraftKings, but we're out of funds. So we've used up our 10K and we need to rely on making more money if we want to buy more stock. So we're down a whopping 21% on DraftKings. Had we shorted that over on my Charles Schwab account, that would have been phenomenal. So we're really down on DraftKings, but on a dollar amount, we're not down so much. We're only down $5. But as a proportion of what we invested, it's 21% down. So ouch, pretty bad there. Apple as well, we are down 6% on. Tech is taking a beating currently. IWM, the iShares Russell 2000 ETF, is also down another 7%. So again, folks, the market has had a turbulent week to say the least. Most of the indices have been deep in the red. Today, as you can see, it started on a really bullish day. As a matter of fact, at 10 a.m., earlier today, our portfolio was up $80. Not bad, but as you can see, it has been just a terrible, terrible day, terrible week for the bulls. And then finally, we have IJR, the small cap 600 ETF, which again, no surprise to anyone, is down 6%. But on a dollar amount on our shares, at least, it's not much. I would say we're probably down maybe $40 or so on our shares. Our options, on the other hand, there's the aforementioned Roku, which we already went over. Let's look at our put spread. Now, our put spread is at max loss currently. So the only thing I can hope is cross my fingers and hope that shit goes tits up and we get blast off. So what this is basically saying, this put spread, essentially we were bullish on SPY. I thought that the bear was over and SPY was going to come climbing back up. Now, luckily, again, I didn't put all my eggs in one basket. Otherwise, I would have been screwed. I would have lost $10,000 just like that had I put all my money in this one place. So there's the importance of diversifying. So this went tits up and it's gone backwards. I am really in the gutter on this one, but that was just part of the road to 100K, is man up and show all the receipts. So currently, all we have to do right now is pray and hope that SPY comes and climbs right back up to $472 by when? By February 2nd, which is really unlikely. If we look at the TA over here, what I'm essentially wanting is for SPY to come and hit $472. So let me get the crosshairs just right. About $472, about right there by this February 2nd. So there's February 2nd right there. Let me make this a little bigger so it's easier to see. So we need it to be at 472, so about there-ish so right there. It's possible. I mean, it could happen, right? It could come right back up, but it's unlikely. So we might have to let this put spread die nobly and just take our loss. I believe our max loss on this was only about $300 or so anyway. We can roll it, but we're just going to have to wait and see what happens. Honestly, it's a waiting game on a lot of these things. You can be really down, and then the market, just decides to go the other way, and all of a sudden you're up big. Just like, for example, on this AMC $21 put, AMC has just been getting crushed, man. Dang, I really feel sorry for the apes who continuously have bought in and in and in time and time again. It's almost like every paycheck, bi-weekly or weekly, whenever these apes got paid, they dropped $400, $200, $50. And it was like their savings account because they were promised the promised land. So ouch, AMC has just been annihilated out there. The put, we had a $21 put. So in essence, what we were hoping for is for AMC to stay above $21. That's when we'd be good. We won't have to worry. We still have some time though. This does expire on the 11th of February, and AMC is a pretty volatile stock. It's not uncommon for AMC to rise $4 or $5 in one day. So it's only $3-ish out of the money right now. Actually, what's the current stock price on AMC? It's at 18, yeah. So it's only $3 out of the money. So anything can still happen. Plus, we're still gaining some money from theta decay, about $5 a day on this. So we're going to leave this as is. I mean, we have to. It's aftermarkets. But the one that I was most interested in is in our snow position. So we have a 2-option strategy. And overall, across the entire strategy, we are down 8% on this play. And that's because here at the very end of the market, it looks like Bean just likes to just make her bed anywhere. Hey, have you realized I'm in the middle of recording something? So this is a 2-option strategy. This was a diagonal call, which consists of 2 calls, one that you buy and one that you sell. This was our leaps that we bought. Let's go ahead and look at it. It is down a whopping $1,500. But that's okay because we have it hedged. In other words, we have insurance against this one. Again, the insurance being the other call that we sold to someone else, which is going extremely in our favor. This one is giving us a return right now of about $1,000. And keep in mind, the theta on this one is much higher because we're closer to expiration. This one expires on the 11th of February. So my counterparty doesn't have much time for this stock to rise back in value. Currently, it's about $30 out of the money. That's a lot. That's roughly about a 10% decline. So my counterparty would need snow to rise by 10% by February 11th, which again is very unlikely. As a matter of fact, I believe I have that exact contract here on my technical analysis. So that purple crosshair is that expiration date, which is the 11th of February. So as you can see, and the strike right here is at about $310 or so. So yeah, $310 for the February 11th expiration. You tell me, how likely is it for this chart to start coming right back up and cross over that? And not only that, it not only has to cross this, but that person also has to make up for the premium that they paid. So their break even is actually slightly higher. Their break even would be at about $325 to compensate for the $1,500 roughly or so that they paid me. I know that's a lot to digest. For now, we're just going to hold on to our horses. We're going to be patient, and we're just going to let this ride out. Remember, guys, not everything goes in a straight line up forever, and not everything goes in a straight line down forever. You're going to encounter turbulence. You're going to encounter some rough patches. You're going to encounter a lot of volatility. But once you get a grasp of how this stuff works, you should be good so long as you hold on and trust your conviction and not make dumb plays. There's a lot of technical analysis and a lot of reasoning behind the plays that I make. If I were to explain in a full video, it would probably take an hour plus because there's a lot of decision making that goes behind this. So I think with that, we're done for this video. So overall, our portfolio is down considerably. We're down about $1,000 right now, but that's okay. Our bearish play that we had on Snowflake is going to net us $1,000 once we close that. we could have closed that position when the market closed, and we would have broken even. In other words, we're down about 1,000. If we profited $1,000, then we would have about broken even. But the advantage is that leap contract, so let's go back to Snow, the leaps contract, which again, leaps is a call option that's deep in the money and far out in expiration, 9 months plus at a minimum. This one expires until January of 2023. So, and it's still in the money. The strike price is for $260, and currently it's at $279. That means there's a $19 difference in intrinsic value. And right now we don't have enough time to go over intrinsic and extrinsic value, but we will soon. So guys, we're chilling. We're here to make money. We do not panic sell, and we don't cut our losses when we're right at the bottom. Why would you do that? I hope you guys learned something today. I know it was a lot, but slowly, hopefully by week 10 or so, a lot of these terms are going to start to become second nature for you. At least that's my goal. So guys, I think that's it for now. It has been a bumpy ride. More than likely tomorrow, Friday, January the 21st, will also be a pretty volatile day. Also, starting Sundays, I'm going to start to do technical analysis Sundays. So I'm going to do a few ETFs, namely SPY, the triple Qs, the Dow Jones, ARK-K, and a handful of stocks that I have hand-picked that will help you guys become better traders. You guys will see my thought process and how technical analysis can help you as a trader. So if you want to stay tuned for that, just make sure you hit the subscribe button down below. And without further ado, guys, I think that's it for now. I'm going to clock out, and I'm going to head to the gym and just relax for the rest of the day. It's been a pretty busy week for me, but hope everyone has been well, and I'll see you next time.